So with this presentation, again, it's how to purchase a home. I am Joseph Robles, and I am with Mile High Mortgage Tailor. So again, thank you very much for everyone being here. So number one, things that you can do ahead of time so you can become a solid borrower. What are some of those things that you can do to become a solid borrower? Hopefully some of this information will point you in that right direction. Some of the basics of financial pre-planning are what are the most commonly asked questions? Those questions would be, what is most important? And then knowing, what do you want to spend? Very important questions that every homeowner and anyone that's in the market would want to know. So number one, a lender or a mortgage broker like myself, we are not financial planners. It is not for us to tell you how to save your money and how to plan your money and how to invest your money. That is your money. That is something that you guys can look at and be able to say, hey, this is in my best interest. Number two, only you can decide your budget. You know, what's my house payment going to be? What am I most comfortable with and what best suits my budget? You know, how does that fit in with any of my utilities, food, credit cards, and more importantly, entertainment. Everybody's got to have some level of entertainment. Then also a general rule of thumb. So follow your house payment should not exceed what we call a 36% part of your take-home income. You know, as a rule of thumb, it can be anywhere between 36 to about 43% in this area is what a lot of lenders will be looking at as far as being within the parameters of what a house payment can be, you know, but it doesn't mean it has to be. Again, it just really depends on a lot of different factors. As an example, if you were to take a home that is $6,000 a month, or your take home, I'm sorry, excuse me, is $6,000 a month, then your budget for that household would be roughly around $2,160, which is about 36% of $6,000. Your max payment is comprised of what we call principal, interest, taxes, and insurance. There are some examples of what we call upfront costs. And what are upfront costs? Well, some of those upfront costs is what people would always think of when it comes to purchasing a home, and that's down payment. A lot of people have this idea that down payment is 20%. Well, not necessarily anymore. You know, there's a lot of great programs that are out there. Some great examples of that would be the conventional loan. A conventional loan is only requiring a 3% down. At best, or at minimum, you need to have about a 620 credit or better in order to qualify for that. FHA's got a great program out there where a down payment can be 3.5%. With that, if you have a 580 credit score or higher, definitely you qualify for that FHA loan. But if you fall in the parameters of like a 500 credit score to a 579, then that's going to change how much down payment that you may need. And that's going to be 10% to qualify for that within those credit score ranges. And then the last one is USDA and VA. These are two great products that are afforded to a lot of people. VA, obviously, if you're active duty, reservist, if you're a veteran, VA is a great way to go. It's a fully funded program. It's 100% no money down. Another one is USDA. USDA is a great product that can be utilized by a lot of people. There's a few different restrictions on it, like population size. And as far as the land, you can have acreage on this land. There is a limit to the amount of acreage that you can have on that land. But one of the things that they ask to qualify for this loan is that you don't cultivate or purchase from gain some sort of income from the land. In other words, you can't grow plants and vegetables for sale. So that's earning an income from the land. And the other thing is you can't do any type of like livestock. You know, whether it's like chickens or horses or cows or goats, can't do that for profit. But outside of that, again, another fully funded product that's out there and doesn't require any money down. Awesome option out there. So closing cost, on average, is about 2% of the purchase price. So as an example, if a house was to cost $300,000 times 2%, that would be about $6,000 is what you would need on average for about closing costs. So the next item that we would be looking at is, you know, finding a mortgage lender or a broker. But before we even talk about that, what is the difference between a mortgage lender versus a mortgage broker? Well, a mortgage lender, it can be anyone, like a lender that you see at the bank, someone that you see who works at a credit union. These are regular mortgage lenders. They're basically going to be able to just offer you what it is that that institution has to offer and their parameters and their guidelines for the products that they offer. Whereas with a mortgage broker, there's more of a custom kind of a work entailed with a customer or a client. The biggest part of it is that we're not working 9 to 5, Monday through Friday, and short hours on a Saturday. We're there to do work with you at any given time. More importantly, we have a wide variety and a vast list of lenders that we are working with that may be able to do something that the other can't. So a lot of variety, a lot of options out there. Why do we need to speak to a lender or a broker? And here's why we need to do this. Number one, we need to know, do we even qualify for a home loan? How can we go out and go expect to go purchase a home if we don't even know if we qualify for the home loan? Number two, we need to know how much are we qualified for from the lender, whether it's a broker or a regular lender. How much are we qualified for? Because that's really going to determine what it is that we're going to be in the market for. It may determine on whether we're looking at a townhome, a condo, or a house. Could really determine. The two main types of lenders that the consumer can work with is a mortgage broker, and then obviously there's the option of your local bank or credit union. So continuing on with finding a lender or broker, the most common ways are through a lot of different ways that you can find in the convenience of your own home or on your own cell phone. You know, first and foremost, you can Google some of these folks, which is what most people kind of tend to do. But the other one is that a lot of people go by referrals. You know, a lot of people will talk to family, friends, who have they used in the past, or who have they used most recently. And then the last one is a real estate agent that you can also ask to, because in some cases you may have an acquaintance that'd be like, hey, you know, it might be a conflict of interest if I do something for you, or, you know, I can't help you right now, but I do have another real estate agent friend or family member that can help you out. So always a referral basis. Next one, number 3, getting pre-approved. What's the point of being pre-approved? And how do we utilize being pre-approved? Well, to get pre-approved, we need to know what is the loan type that we're going to be using. Again, I fall back on those examples of a conventional loan, an FHA loan, USDA or VA loan. Knowing what the max purchase price that you're actually able to go out to the market and be able to look at any of those townhomes, condos, duplexes, house. What's the interest rate that I can get pre-qualified or pre-approved for? How much down payment depending upon the loan product that you qualify for? What are some of the lender costs that are involved with this? Estimated costs. And then lastly, it helps get your offer accepted. Gathering documents is probably one of the most critical parts of the entire loan and home purchasing process. Gathering this information is really going to make the entire process a lot smoother and a lot more seamless. A lot of this information are very simple pieces of information that we get on a regular basis. Having the necessary documents available, as I said, makes the process smooth. What are some of these documents? Needs about 30 days of paycheck stubs. Well, what's 30 days? Well, it can be a variety of things. As an example, if you're a federal worker, maybe you're only being paid once a month. So it's one paycheck stub. Shows your entire month's income. If you get paid bi-weekly, 2 paycheck stubs. Or if you get paid on the 1st and on the 15th of each month, still 2 paycheck stubs. So a full 30 days is what we're looking for. 2 years worth of W-2s or 1099s. That's really going to fall back on number 3, which is going to be tax returns. You know, in some cases, depending upon the loan product that you're looking for, and definitely what type of employee you are, like myself, self-employed, I'm going to be a 1099 employee. But if you're working for a company or a corporation or anything like that, you're going to be a W-2 employee, at which time how we work on getting or utilizing or needing that information is going to change. Next point is 2 months of bank statements. We need the bank statements in order to be able to verify where the monies are, the monies that you're planning on using as a down payment or anything else as part of the loan process. We can't just say, hello, one of these days money just magically appeared in my account and now I'm going to use that to purchase a home. There's some rules and regulations that govern why we need to be able to verify the source of these funds. And then the last one is identification. The most common piece of identification is a driver's license. All of these items are items that you can scan yourself, either on your cell phone and save it as a PDF file. You can put it onto a Google Cloud as an example and be able to save those documents there. So as you do go to a lender or to a mortgage broker, and they're going to ask you for these documents, you can immediately upload these documents and get it to them, and they're there ready for them to utilize so they can get you pre-approved and get you going on the loan process. What are some of the things that we can expect once we get this loan process going? Well, the first thing is that we need to fill out an application. The application is going to ask for your basic information, name, your address. You know, it's going to ask for your social security number, your date of birth, basic information. But it's also going to ask for some other things. And there's going to be a list of questions towards the bottom of that application that you would just need to check mark either yes or no to any of those questions. Very simple. The next thing, we're going to need to pull credit. And a lot of people have this stigma of, well, I know what my credit score is because I use Credit Karma. Well, that's an estimated number, not an exact number. The exact number for a credit pool is crucial at this part because we really need to know where you are. Everything is going to be based on it as far as the type of product that you would qualify for, the interest rate, everything. It hinders on your credit report. So accurate numbers do really get based on this. Next one, attach all those necessary documents and send them to your lender or broker. Again, if you can save them as a PDF, it is the most preferred way by any lender or any broker to work on getting those applications looked at and funded. Number 2, receive a full quote, or what we call a TBD loan estimate. The TBD stands for to be determined. That's what that is. And again, it is solely an estimate of where we think you are. We can't really get into diving into specific numbers until we have other information, such as an exact address of the property that you're interested in purchasing and what the sale price of that property is. All going to make huge differences to get to exact numbers. But once we have that, the last item, which is the most important item to you as a consumer, is going to be your pre-approval letter. This pre-approval letter is crucial in the process of purchasing a home because once you have that pre-approval letter, now you can work with any real estate agency or group or any particular realtor, and they know that you have already done everything you need to do to be active in the market today. Once you have that and you can hand that over to them, they are ready to go to work for you tirelessly to go get you that piece of property that is going to make your dream come true. So comparing loan offers, This is something that a lot of people can do, and there's a lot of great information on this. If you wanted to, as a consumer, go and get more than one loan application filled out, by all means, please do. If you wanted to go out there and go say, hey, I'm with this particular bank institution, I want to compare them with this broker. Where do I get this information? How can I utilize this information? How does it work for me? Knowledge is power, and this is something that we encourage for everyone to go out and go do. What we call the CFPB, they have this great website, which is this link that I included right here. If you click on the link, the Consumer Financial Protection Bureau, this page right here, if you just scroll down, you don't even have to click on anything. It's going to take you right here as an example of what a loan estimate looks like. And on the right-hand side of that page one of this document right here, it's telling you highlighted what are all of these areas here. As an example, if I was to hover over the very first box right here, if you look at the page one document just to the left of that, you will see that the applicant's name and address is now highlighted. It's got a box around it. And so any area that you go to here, it's going to highlight that section on that document. And it's going to be able to give you all this information as far as where this property is, how much is the sale price for this property right here. The next section of what it's saying as far as loan terms, all this information is going to be able to be here because no two entities will put this information together for you in the exact same place. So if you were to go to a banking institution and ask them for a loan estimate, they're going to give you their loan estimate. And that information may not always be in the same place, like I said. But if you ask them for a TBD loan estimate, they will give you this form right here. Now you're looking for the exact same information in the exact same place, regardless of whether you got that estimate from a banking institution, a credit union, or from a mortgage broker. Now you can take those estimates side by side and have the ability to break down the numbers specifically and be able to know, is this the best person I need to be going?
Yes, overall.
There you go. So that information is available for you on this hyperlink that's here. All right. So again, I've already highlighted some of these areas that are here as far as where the loan terms are, loan amount. Interest rates are also applied here on page 1, and principal and interest. The next item is what we call risk features. What are risk features? Well, there are items such as what we call a prepayment penalty or a balloon payment. And some of these are actually specific to the type of loan product itself. One of the ones that most people know is what we call an ARM, or an adjustable rate mortgage. That is very indicative of having what we call a balloon payment. In other words, for a set number of years, you're going to have a very steady house payment. And then by year 15, as an example, then all of a sudden it's going to start going up. And it's going to have that balloon payment. In other words, you've already paid off enough to it. Now comes the balloon payment. The rest of the loan is just due in full by this day. So this is one of those things that was what we call a risk feature. And right here on form number 1, in this little circled area that I have right here, you'll see that it says prepayment penalty. Just to the right, it tells you, yes, it does have a prepayment penalty, and then it gives you the descriptives just to the right of it, excuse me. Right below, it's also talking about the balloon payment, and here it says no. Ideally, with this product, you want both of these to say no. Projected payment, mortgage insurance. When does it fall off? Well, if you look in the next section where it says projected payments, it's talking about that specifically. And it's the second item down, like mortgage insurance. Here on this example of this loan for $162,000, it says that there's $82 a month being applied towards mortgage insurance. But if you look to the column just to the right, it says by year 8, that $82 now falls off. And that's because it's met the requirements in order for it to fall off on your loan. So instead of your loan payment being $1,050 a month for the first 8 years, starting year 8, now it's only $968. So being able to have this type of information available to you, as you can see, it's invaluable. Going on to page number 2, it also continues to give you some information, but this one's a lot easier to kind of digest a little bit. Here we have what we call loan costs, which is going to be in your section A. This is where the lender charges are located. Note, these amounts are based on the lender you choose to use and not the property you decide to purchase. This is critical, okay? Because lenders are going to have different charges. Not every lender has the same charges. So that's going to be solely based on the lender you choose, not on the property you're purchasing. Okay. Next one, section B through J. All of these are estimates by the lender. Okay. Until you actually go ahead and you sign and you want to make an offer on that property and you go under contract on that property, everything is going to be an estimate. Until you actually go under contract, those specific numbers will then start coming in here on what we call a closing disclosure, where those numbers are more accurate. Here, though, on this note, as you can see, we put that these amounts can change based on the property and not on the lender. Because these numbers from section B, which is this one right here, the one right below it, and all of this and other costs, these are solely based and are driven on the actual property itself, not on the lender. So that's why that's really critical in being able to know all that. And the last section, which is down here, calculating cash to close. This is very important because that's what everybody wants to know. How much money do I need to be able to bring to the table? What am I going to be required to have in hand as a cashier's check to bring to the closing table? Well, this is where these numbers come from. It's going to be part of that lender cost. It's all going to be part of that section B through J, all that. And it's also going to be broken out down here to these items right here, which is closing cost, finance, paid by your loan amount. Down here, as far as down payment, funds from the borrower, this would be anything that's here, and then a deposit. You know, so you may have $18,000 here, you may have $10,000 in credit right here. But when you calculate all these numbers, what you need to have at the closing table at the end of the day is a total of $16,054. These numbers are all calculated here, and these will account for any type of concessions that are coming in from the seller, so on and so forth. The last page has just got some helpful information on here. The things I really want to highlight on this page more so than anything is the comparisons, because this right here is going to give you some information based on what happens in 5 years as an example. On a basis of this being a loan for $162,000, as it said on page 1, in 5 years, you would have a total of $56,582, which would be the total you will have paid in principal, interest, and mortgage insurance and loan costs. That's where that number comes from. Next, you'll have on there an item called annual percentage rate, your APR. In 5 years, it would be an amount of 4.274%, which is your cost over the loan term expressed as a rate. And then the last one is what we call TIP, or your total interest percentage. In 5 years on that loan amount, you will have paid a total amount of 69.45% in interest in the first 5 years. And it sounds like a very huge percentage number, I get it. But when you look at a loan every loan, whether it's a home mortgage, whether it's an auto loan or any other loan. All the interest is always on the front of the loan, working towards having a lower interest amount that you're paying towards the backside of the loan. So that's why this is such an exorbitant number here on this percentage. But that's the type of information you'll find here on page number 3. So making a decision, this is going to be one of the hardest things that you're going to do on how to decide, do I want to go with this lender who's a financial institution, credit union, or do I want to go with a mortgage broker? But what are some of the deciding factors that goes into making that decision? Well, it could just be based on low cost, which is what most people would like. But there's also your gut instinct. Your gut instinct is a huge part of that decision. So knowing and understanding, having that loan estimate from your financial institution and from a mortgage broker and seeing those numbers side by side, and what your gut is telling you is what's going to create what we call your best option on who you should go with. This is really going to come down to, and I'm on the bottom paragraph down here, that this really comes down to the combination of the two factors. After reviewing your options from different lenders and brokers, don't forget your gut instinct. Gut instinct is knowing how this particular lender or mortgage broker, as far as work ethic, has been thus far. If they have open and honest communication, what is their availability? Have they answered the phone when they called, or did they respond to your email? And overall, the feeling about them. That's your personal interaction. That gut instinct will really weigh heavy on your decision on whether you go with a mortgage broker or whether you go with a lender. Major don'ts in this particular process, and this is the one that a lot of people love to go do because they get very excited about going and purchasing a home, a townhome, condo, or whatever. But a lot of people want to go make major purchases. And this could really hinder your loan chances in getting it approved and getting it funded or getting that home to become a reality. So what are some of those major don'ts? Well, these are things not to do when purchasing the home, and the most common mistakes that people make that impact the process is, number one, making any major purchase, such as a car or any new furniture. If you're going to do it by opening up a line of credit, that's going to impact your credit, and it's going to show up when we do another hard inquiry at the end of the loan process, because it will show up. Number two, change or quit your job. Any lender is going to want some level of stability when it comes to funding a loan. So as a rule of thumb, most lenders need 6 months of work history. So just know and understand that and keep that in the back of your mind, because it will have a really profound impact on whether or not that loan will get funded or not. Moving large amounts of money in and out of accounts or between accounts. Again, history has dictated that there's been a lot of fraud, unfortunately, and Uncle Sam doesn't like when a lot of large amounts of money is being moved around, because, again, we need to do that verification of funds, hence the bank statements. So that's why that's really important. Number two, paying off debts or any collections. Once you make those payments, you're saying, yes, that was my debt, and it's going to go on your credit report. Some of those things, and this is really one of the reasons why knowing that you can talk to a credit repair person and get them to help you out, get that financial planning taken care of, or get your credit taken care of, all of that can be explained away, or it can be just not even accounted for in the loan process because it may fit a particular criteria where it doesn't have to be accounted for. Hence, we can explain it. And that all goes through some of the underwriting process. And then late payments. Some people will say, oh, well, you don't have to make a payment for 30 days or 60 days, and people believe it, and then they're like, oh, I don't have to pay that. Make the payment. Don't make late payments. If you know you got a payment, make that payment, get it taken care of. Finding a realtor. So everything that we've done on getting pre-approved and so on and so forth really makes this process really easy. So what are some of the helpful guidelines that you should follow? Well, don't use a dual agent. What is a dual agent? An agent is a person who represents the seller of the property and you, the potential borrower or buyer of the property. Okay. So that's huge, because how are they going to be able to have your best interest in heart if they also represent the seller at the same time? Conflict of interest, it's very hard. Always have your own real estate agent who's not representing both properties, because it does create a bit of an issue at times. Explain your scenario to your agent and see how they respond. In other words, everybody's reason why they're in the market to purchase a home is going to be different from the person next to them. And having that open and honest communication and that conversation with a realtor is really going to set the pace on, is this the right person for me? Again, gut instinct. How do you feel about it? Helpful versus salesy. What does that mean? Well, after having that conversation, is this a person who is really just trying to push for the sale? Or are they really working to have my best interest at heart or in their mind? Ethics is huge. You'll get that sense after you have that conversation. Experience isn't everything. You know, yes, experience is what everybody knows, that this is the person who's got the best experience. They're going to get this done. It's going to be easy. It's going to be that. Well, fact of the matter is, they were new at one point too, and they had to start off, and someone had to help them. Experience is not everything, because this newer person who may be new to the real estate company or agency or group, they may be just the right person who's going to be that person that's going to fill that gut instinct portion of how you're making your decision on what realtor to go with. Always be open-minded, and again, have that communication with them. And lastly, trust your gut with them. How can you find good realtors? Well, again, it can just come down to referrals from family, friends, and everything else. And again, you can Google them, however that works best for you. Shopping for homes, do's and don'ts. This is also very critical for a lot of people out there. Follow your agent's MLS. Okay, MLS standing for Multiple Listing Services Updates. This is huge, because if you're wanting to look at a house, but the house has been on the market for a little bit and it hasn't been updated or anything else, that house may already be under contract, and so you're getting your hopes up for nothing. Right? So always track the MLS, the MLS for your agent, and see what are the newest properties that are hitting and how often are they updating, so that way you can do those things to be looking at the most recent postings of homes. Stick to your lender's max price limit. Again, knowing what your budget is. You know, if your pre-approval amount, as an example, is $450,000, don't get yourself set up for emotional disappointment by looking at a $500,000 home. You know, unless of course there's some funds that haven't been discussed that'll help you get there, it's not really worth it. So knowing what that max price is and staying within that budget, and sticking to your monthly budget. Again, how that's really going to help you. Use your whys to set a timeline and urgency. What are some of these examples? Another one, you could be looking to be relocating for a job. Maybe you have a rental agreement that's coming up in 2 months, and you want to get into the market. You want to make sure you got time to get out there, purchase a home, so when that terminates, you can move from the apartment into your household, and knowing your whys. That's really going to make huge differences there. Make a needs versus a wants list. This is huge. I don't know of anyone that's in the housing market that doesn't want turnkey. Turnkey is what everybody in the market wants. Everybody loves turnkey. But be realistic. Maybe turnkey is not going to fit your why. Maybe it's not going to fit within that timeline or that urgency. Be realistic that maybe I can do a code of PIN on my own and be able to work with something else may suit that. What are some examples of don'ts? Don't get emotionally attached to anything that you go out and go see. It's one of the worst things that can happen is when you get emotionally attached to any of those because you're setting yourself up for disappointment. The realistic portion of it is that sometimes we can be outbid for a property, and it can be very hard. Number one, move too fast or move too slow to schedule showings, depending on your market and your why. You know, don't do that. You know, always know, hey, I don't want to sit on my heel to try and schedule a showing to go see this property. Even in today's economy right now, we still don't have a very huge inventory, but people are reducing the prices on homes, and homes that are up for sale are sitting on the market a little bit longer. But you still want to make yourself available to be competitive into that market for that house. So don't sit on your heel for these. Another one, feel like you need to see every home. Your realtor may be doing a great job of getting some showings set up to go show you some homes that are going to suit your need and everything else. But if you've already seen what you need and it fits your whys and your price point, and your budget, and it was only the second house you ever saw, you really need to go see house number 10. Why put off tomorrow what you can do today if you've already found what you're looking for? Stay with that timeline. Okay, writing an offer. How does it work? Well, writing an offer is something that you as a consumer work with your realtor. Once you find that home that you think is going to be the one for you, then you want to get in there and you want to negotiate what you want. And it's not always just about price. Right now, again, concessions are huge with sellers. Maybe there may be a repair item. Maybe it's them helping you with some down payment costs for closing or whatever the case may be. There are some items, as an example, if a roof looks like it needs to be repaired, it came back on the home inspection that it needs to be repaired, maybe you can negotiate that. The seller can accept or counter your offer. That's just the reality. Once you identify something, you go ahead and you can make a suggestion to them for what it is. And as the seller of that home, I can either accept that or I can reject that offer. If accepted, the contract becomes binding and it is the roadmap of the transaction. So anything and everything that is negotiated and is agreed upon and the seller accepts those terms, that is now your binding contract. Tips: write an offer that helps you win. Always put your best foot forward. In today's market, and a lot of people I'm sure already know, especially over the last 4 years, when it was just a crazy real estate market, people can put in an offer just to find out that they weren't even close. They were outbid, and yeah, so always come with your best foot forward. Increase the chances of getting that home you want. Always ask your agent, how can I make it, your offer more competitive? You may not have the answer to that question, but your real estate agent may be able to help you with that. They can turn around and they can look and they can talk to the other realtor and get those things going. Also, there's consider a compliant offer letter, and then you can ask your lender to call the listing agent. So there are some options there. Home inspection. This is very critical. How it works is that you get a certified home inspector to examine the home and identify any issues to bring to your attention. You get a copy of that inspection once it has been completed, and your contract will determine if and when you can negotiate repairs to be fixed by the seller. Okay, changes can be done. Often it can be a big moment of change, and buyers can back out or request repairs, concessions, or negotiate terms, etc. The underwriting process, this is very critical because it falls right back on a lot of things we've already discussed. But to highlight a few of these points, the lender can take the pre-approval letter and work on finalizing the full offer. There's a note here that the conditional approval is different from the pre-approval, as the underwriter may need more information. So you've already done a good job of collecting your documents, having them available, attaching them to your loan and everything with your application. but maybe there's just something that's there. Maybe when they submitted the loan, there was a condition that came back that we need to explain, and it may require some additional information. Like as an example, maybe they just say, hey, there's this property, it shows up on your credit report. Do you still live at that property, own that property? Maybe it's just a letter you need to write to explain I've already sold that property, I don't know. So a lot of good things on here. Homeowners insurance, this is also very critical, but this is on you, the consumer or the buyer. One of the requirements of the underwriting process is to have homeowners insurance. At this particular stage, this is what you'll want to get, the insurance to cover items such as fire, natural disaster. Okay, once you have this policy, it's really critical to take what they call the declaration page, and you want to add that to your documents that you already have collected, whether it's on a Google Drive or a cloud that you have somewhere, but definitely keep that because that's going to be critical. You can shop for this insurance coverage and find the one that works best for you. Monthly included in the mortgage payment, because what they're going to do is they're going to collect a full year up front when you're purchasing this home. And then they just break it out as part of your monthly payment. And it all has a lot to do with the monthly payment that it's established with your escrow account, so on and so forth. Okay, the appraisal, which is the home's value. How does it work? Well, the lender that you're working with is going to order that appraisal for you. The appraisal is mainly for and ordered by the lender. Ideally, the appraisal value will be at or above the purchase price. In some cases, the lender, in every case, the lender will always use the lesser amount, whether it's the purchase price or the appraised value. Okay, and we have an example of that here on this next screen. So in scenario number one, if the purchase price of this property that you're looking at is $400,000 and the appraised value of that property came back at $410,000, then the transaction or the contract for the purchase price of that house would be $400,000. There is an example of a different scenario, which is number two, which is if the same house, which is the purchase price being asked at $400,000, let's say the appraised came back at $390,000 less than what they're asking for the house. The transaction price would be $390,000. So there's a couple of different options here. One, the buyer of that property could come up with $10,000 to make up that difference. The second one is that the seller can come up with the $10,000. The last one, it could be a split between the two. Maybe the seller will make the difference $4,000 or $5,000. You, the buyer, make up the $5,000, and together you make up the $10,000 on that transaction. So just before closing, the following items have to be completed. We have to have that pre-approval, have that conditional approval, get the home inspection, have the appraisal, and have all the documents submitted and verified by underwriting. This is the entire process in a nutshell that's going to be able to get this taken care of for you just before closing. And at this point, we are going to be what we call clear to close, which is music to most people's ears in the industry, because everyone wants to be clear to close. So now we're clear to close. What does this mean? It just means that we are at the final stage of completing the transaction of purchasing. The final copy of the closing disclosure, or what we call the CD, which is what it's most commonly referred to, will be sent to you for your final review. This is critical. This is something that you want to be able to make sure that you can have access to and look at it and verify it against your loan estimate for that property that you've got. You just want to make sure that there isn't any major numbers that change so dramatically, because if there was, there could be a problem. So it's really important to be able to review that document, okay? And it's also going to be going to tell you usually what you need to have for cash to close. This is more than likely going to be a cashier's check that you can get ahead of time and take the closing there. Okay. Note, you will be doing what they call a final walkthrough of your new home at least 24 hours before closing. Okay, so if there's something that hadn't been completed or whatever, maybe it becomes a condition to close. At closing, so we're on the home stretch here. What to expect, excuse me. Usually your lender will be there with you. You're always going to have someone that was there in the process there with you at the closing table. You'll get a copy of all closing documents. You can get it in the form of a CD. You can have it emailed to you, or they can just give you this big old stack of paper and a folder and say, here you go. I hope you got room in your filing cabinet for it. And then you'll also get keys and occupancy will be exchanged according to your contract at that time. Your first payment is usually due within 30 to 60 days, depending upon your close date. Principal and interest payments won't change if it's a fixed loan rate. Also, pay attention to your escrow account, which is going to be your taxes and insurance. There could be changes to the taxes and the insurance, so make sure that you pay attention to that. And at that point, that is the very last slide that I have for this presentation. As you can see, there's a lot that's involved when it comes to the entire home purchasing process. For you, the consumer, is when you're ready to say, I want to be in the market. I want to be a buyer. I want my dream to come true. There's things that you can do to help yourself before you get into the market. And there are things that you can do when you're actually in the process. Go back, look at these slides, and use them to your best advantage. I promise you they'll benefit you going forward. Are there any questions?
Am I better now?
Yeah.
Awesome.